All right, let's unpack this. We're doing a deep dive today into something pretty striking, the prime central London property market.
Yes, and specifically looking at that recent Knight Frank data, it really gives us a window into, well, what happens when policy seems to push against high-end wealth?
Exactly. Our mission here is to sort of connect the dots between this specific slump, in PCL property, and the frankly huge fiscal balancing act the UK government is trying to pull off right now.
It's a tightrope walk for sure.
And the core idea, really, is that trying to grab more government revenue through certain taxes might actually be, well, shrinking the pot. It seems counterintuitive.
It does, but the numbers are quite telling.
Right. The key stat here. Prime London property sales fell 7% in the 6 months leading up to May compared to the year before. 7%.
And maybe even more telling, the number of new buyers, potential buyers registering, dropped sharply too, down 13% in that same period.
That feels like capital making a decision, doesn't it? Not just a temporary pause.
It suggests a definite cooling from that specific buyer pool. And look at prices. PCL prices were down 2.2% year-on-year to May.
Which the report noted was the steepest annual fall since last August.
Correct. And the quarterly fall, 1.4%, was the biggest dip we've seen in almost 5 years. Now, the question you might ask is 2.2% really an exodus? Or is it just, a bit of normalization?
That's a fair point. But if it were just broad economic blues, you'd expect to see weakness across the board, wouldn't you?
Exactly. And that's where the market split is so fascinating. Prime outer London think areas driven more by domestic buyers, people buying because they need to move, maybe for schools or space.
More needs-based.
Right. Prices there actually rose by 1.1% over the same 12 months.
Okay, so that really isolates the weakness. It's not the whole London market. It's specifically that top-end, international investment-heavy PCL segment.
Precisely. And the analysis points the finger pretty directly at two main policy shifts driving this divergence.
Which are the higher stamp duty rates, that's the tax you pay when buying property.
Yes, tiered quite steeply at the top end.
And the other big one, the phasing out of the non-dom status.
For our listeners, non-dom refers to that tax status allowing wealthy individuals living in the UK, but domiciled elsewhere for tax purposes, to not pay UK tax on their foreign income or gains.
So take away that significant tax advantage.
And perhaps the incentive to buy that multi-million-pound London base diminishes for some international buyers. It changes the calculation.
Okay, so connect this property data to the wider political picture. It gets really interesting here.
It does, because it highlights this massive tension within the government itself.
Yeah.
We had the Prime Minister, Keir Starmer, saying pretty clearly recently that the UK can't just tax its way to economic growth.
Right, I remember that. But wasn't there a leaked memo suggesting something different?
Exactly. That statement followed a leak, reportedly from the Deputy PM Angela Rayner's office to the Chancellor, outlining potential ways to, raise revenue through various tax measures. So, conflicting signals.
Which puts the Chancellor, Rachel Reeves, in a really tricky spot. She's got these fiscal rules she wants to stick to about limiting borrowing.
Self-imposed rules, but rules the markets are watching very closely.
So, with this backdrop of wealth potentially leaving, or at least hesitating, what are her options? It sounds like a classic catch-22.
She basically faces three very difficult choices. Option 1, cut public spending significantly, that's never popular politically, and hit services.
Always tough. Option 2.
Raise taxes elsewhere. But again, that's unpopular with voters, and as this PCL data perhaps hints, raising certain taxes might actually backfire if it drives away the very activity or wealth you're trying to tax, diminishing returns.
Okay, so cuts are hard, tax hikes are risky. What's the third way?
The third option is to try and persuade the financial markets to let her relax those fiscal rules, essentially borrow more.
But that's risky too, isn't it? After recent market volatility.
Hugely risky. Any sign of loosening the purse strings without a credible plan could spook the markets, push up government borrowing, cost those bond yields, and that feeds directly into higher mortgage rates for everyone.
Ouch. So it ripples out.
It does. Which is why Tom Bill over at Knight Frank summed it up by saying, any policy that ends up driving away foreign investment or actually shrinking the tax base seems to have, quote, obvious flaws in this kind of tight fiscal environment.
Okay, so let's synthesize this deep dive. The attempt, or maybe the perceived attempt, to capture more wealth via higher taxes and policy changes like ending non-dom status
seems to be demonstrably cooling activity at the very top end of the property market.
leading to the risk, at least, that the total amount of tax collected might actually go down, not up. It shows how fine that line is between taxing wealth effectively and inadvertently encouraging capital flight.
Absolutely. And that leaves a really important question for you, the listener, to think about. If the ultimate policy goal is to boost government revenue, but the chosen method starts to cause a noticeable exodus of wealth, how do policymakers figure out where that tipping point is? How do they measure when a tax becomes counterproductive before it potentially harms the UK's overall economic appeal?
A crucial question indeed. Food for thought.